Well, hello guys. Let's go ahead and kick off. Thanks for joining us today. This is our Ask Me Anything E-Series, an open conversation for entrepreneurs. Thanks for joining. Look forward to answering your questions today. If you have any further questions, my email is there on the screen, hallmartin@10capital.group. Feel free to email me after the session as well to ask any questions and be glad to work with you on it. So with that, let's go ahead and kick off our session. So I often get asked the question, why do startups fail? And there are many reasons why startups fail, but there's one common reason that most reasons trace back to. And so is it because they're new? Sometimes. Are they doing unproven things? Potentially. Did the market change, or did the customer preferences shift? Or was it because they didn't have funding or access to customer accounts? And all of those are answers I often hear about why startups fail. And there's some validity in that. We just went through the COVID pandemic, and there are a lot of things people did not foresee, a lot of things they did not forecast, and there are many companies that will go under because of that, or change dramatically what they're doing. But I maintain the main reason startups fail is it comes back to one ultimate source, and that's the team. The team is the most important part of a startup. Whether you're an investor or a CEO or a founder, realize the team you build is what's going to carry you through the tough times, the unforeseen times, and the difficult times. Almost every startup failure I've seen as an investor have been traced back to the team not being up to the task. We may have underestimated it, but in the end, we really wanted the team to solve that. And so as you build your startup, you want to look hard at the team. As you invest in startups, you want to diligence the team. Spend time with the team to understand their skills, understand what they can and can't do. And so what we want to do here today is talk about things that we can do to help you get better prepared for investing in startups as well as in running startups. In many of these unforeseen events, you will go through pivots and restarts, and that's just part of every startup's journey. And the team must be prepared to change to meet this challenge. So this is what we're going to look at here in the next few moments. So let's kick on through this. Let's see. One of the things you'll find is as the company grows, the team must be able to cut costs and attack new markets and turn on revenue streams. The team must be able to work without funding for a period of time. In this COVID pandemic, what we saw is that many teams were put on hold because the revenue was not there, the customers were blocked from coming in, and the team must be able to work even without funding. And so failed startups often point to a lack of funding, competition, regulations, but with the right team, you can overcome these things and find alternative ways to fund the company, find alternative ways to keep the lights on in the building. May not be part of your original growth plan. If you're a tech startup, you could consider moving into consulting for a period of time. You could look for one or two anchor clients to pay you a contracting fee for special services or special work to be done. And these are ways to keep the company alive for another day. Again, it wasn't part of your original plan, but it's one way to continue to the next stage. So, as a CEO, ask yourself, are you building a team that's able to adapt to changing conditions? Will they be able to survive COVID-like pandemics in the future? And how would you survive COVID-like pandemics in the future? Maybe you need a different type of team, a different skill set, a different business model for a period of time. But if that's required, then that's what we should do. And then investors, also ask yourself, if you're planning to invest in a startup, does the team have all the skills necessary to work through the ups and the downs? And look hard at their ability to do all of the above that we just talked about and do what's on the current plan. Plans change, strategy shifts, and market moves, but the team is the constant that carries you through all of those. So if you have questions about that, feel free to post that in the chat box or the Q&A section, and we'll get back to that here in a minute. So we've had a couple of questions come in as we were talking. So let's go get to those first. So first one is from David Blankman. David, thanks for joining us. Hall, thank you. You touched on valuations on your last webinar. do you think 20% haircuts are uh, the normal in economic times? Is this a fair level now in the near future? And what parts of the valuation parameters are the most affected by economic stress? And so in the 2008 downturn, we saw valuations go down by 20%. And this one, I've heard anywhere from 20 to 25% as the valuations will go down. Crunchbase did a report before the pandemic, and they found that most investors thought the market was overvalued by about 30% on the private side and also on the public side. So we could be up for a 30% haircut in this upcoming going back to normal, as we'll call it. So, and then of course, in these type of situations, funding shifts to the best companies out there. So if you're at the top of the list, well, then you'll probably raise your funding, maybe not all of it, but some of it. If you're not at the top of the list, you're at risk for not being able to raise your funding just because there's not as much funding out there as there was before. This is the one time where it's best to be in the seed or Series A category, and the time where it's tough to be in late Series A and Series B and Series C. And I say that because when you're a seed and you have 200 or 300K of revenue, or your Series A and you have 600-700K of revenue going to $1 million, you're not as at much risk as when the economy takes a dip, and that's because you don't have to lay off half your staff. You don't have half your revenue go away because the customers have gone under. With your seed, you don't have that much exposure to revenue or employee count, and so you don't have to fall back so much. You do have to look at where the market is going and adjust and pivot over to it. When Series A, same thing as well. When you're at Series B and C and now you have 50 employees and you have $5 million of revenue, you're probably going to take a much bigger hit because half the revenue and half the customers going away is going to have a big hit on your employee count. And also your ability to raise funding is harder, because when we talk about funding being harder, it's really the later stage fundings, B's, C's, and D's, that get cut first, because those are large dollar items, and those are the ones that are going to have to do the most pivoting and re-engineering of their sales force to get back to it. So in the seed and Series A, there's not as much stress going on. And the parameters that people look for is one of the key ones, aside from revenue, is margins. And that's what you want to look at in businesses, is how much margin do you have in gross margin and profit margin, if you have anything near break even. And the reason I say that is because if you can improve their margins by 5 or 10%, that's just like raising another $200,000-300,000 of funding for your business, because that's money that will go back into your business that you don't have to go raise from outside. So you want to look hard at the margins in your business, because investors are going to start looking harder at those gross margins as well, to see how much cash you're able to put back into the business versus paying for the product itself. So that's one question we have here right today. And so next is the question is, how do you establish a culture of accountability, especially in a remote context? And I think the answer to that question goes back to, how did you establish a culture of accountability to begin with? You have to have very good detailed job descriptions, you have very specific roles, and you have times in which you have to come and demonstrate you are doing your work. And whether you're in a central location or you're in a remote location, you have to have very clear ownership of metrics and duties and results, whether that be rolling up accounts or closing them or reporting on them. You must have who's going to own that and document that. This is one of the biggest challenges with startups, is that in the early days, you're just trying to build the business, but at some point you get to a place where you need to document your business. You need to write down everything that you need to do to run that business and assign accountability. And the best way to enforce accountability is to shine a light on it. So for example, if I'm responsible for rolling up the results of a sales campaign and I need to have the metrics, at some point you should ask me to stand up and present those results to the others in the group, either my team or the company, and show what you actually are doing and put a spotlight on it. So when I worked in the big company, whenever I used to run a division at National Instruments in which I was opening up the offices in Europe, and I had a dozen different countries, everybody, working hard on what they were doing. I would, and they would ask me a question, how are we doing on, say, education, customer education? What I would do is go run a report, get the results, sort it from top to bottom, who was doing the most down to who was doing the least. I put that on a report and I would share it with all of the people that needed to know and say, well, this is where we are, as well as the people in Europe. And I found that just by shining a light on it, it really enforced accountability because everybody's looking at it. Everybody's discussing it. Nobody's making decisions around it, but they're looking at it. And so if you felt like you were underperforming, you would get on it pretty quick. And so that helped a lot to shine a light on it. So having accountability goes back to defining the roles, defining the responsibilities and the metrics, and then putting some spotlights on it from time to time to see how you're doing. If you're doing well, then that's a real plus too. So thanks for the question there, Caldwell, on that one. So we had some other questions come up before this. I want to thank you guys for joining us today. And then the first question that we got from Thomas was, what do those coming from the corporate background miss or get wrong about the startup world? And I think the things I've seen coming from the corporate world myself and then seeing others come from the corporate world as startups is, number one, you have to put, in the startup, you have to put the whole system together yourself and with a small team. And with the corporate world, someone else is putting it together and you're part of the team, and so you have a piece to own. But in the startup, you own everything and you're accountable to everything. And in a startup, you have to do the entire system. You have to find your niche, build your product, close the sale, keep the customer happy, and then rinse and repeat. Do it again. And you have to keep doing this over and over again. And you have to own the entire process from start to finish. It may not be as large as what a big company did, but something you have to do. Second thing in the startup world is you have to initiate tasks. In the corporate world, strategic plans and other people initiated tasks and then you reacted to it for the most part. But in the startup world, you're not reacting to much. You're having to initiate things and others react to it. And then one thing I found in the startup world is every day I learn something new. Every day I learn something new. It's about new tools, about new markets, about new companies, about new technologies, there's always something new. So it is the way to learn is to go into the startup world because you will find out every day something great and new is happening that keeps you on your toes. In the corporate world, you don't learn nearly as often. From time to time, you'll learn something new, or at the very beginning, you'll learn quite a bit because you're getting used to it. But after a while, you plateau pretty quickly in the corporate world and you're not learning every day. And then the last one is in the startup world, you're accountable for all metrics, whereas in the corporate world, you are accountable for one or two metrics or three or four metrics or a smaller number of KPIs that you have to take care of. And so that's one thing to think about is when you own all the metrics, you have to start making trade-offs. Where do I spend my time? Do I spend it on this one to improve that metric, or do I spend it on that one to improve that metric? Because where you don't work, it will not move for sure. So that answers the first question. What do those coming from a corporate background miss or get wrong about the startup world? The next question is, personally, meeting the entrepreneurs has been key for investors. How does this work with current restrictions? And I've talked to many investors about the difference between a Zoom call or a virtual meeting and meeting in the pitch room and meeting face-to-face and having FaceTime with the entrepreneur. And for example, I was in an angel meeting last week, and it was the first time that we had done a virtual meeting. Before that, we were actually in the room with everyone. As we switch from in-person meetings to online, a number of things change. Number one, there's a lack of visible cues and body language. You can't. One of the reasons you like to meet with the entrepreneur is you want to size up communication skills, confidence, and how they carry themselves, because this is how these are the skills they're going to take to selling customers and recruiting employees and lining up partners. And those who can exude confidence are going to do better than those who cannot. And that's a key part of the investment process, is figuring that part out. And on Zoom, it's there, but it's a little bit limited. It's not as easy to capture body language, because you're usually looking at just the upper body, and you don't get the nuance of the answers to questions. You get the answer, but you don't really get all the details that come out of it. And so you get the content, but I'm not sure you're actually getting the relationship as well. Because one thing about being in the room with someone or sharing a coffee with somebody is you're building a relationship that carries forward. And in funding, that's the key issue, is to build a relationship with each other. And so online, you'll find that the time is limited. In general, the online meetings are about half the time that a physical meeting is, because you chop down to the very bare essence of communicating content, but you've kind of chopped out the part about building relationships. And then also in physical meetings, what you have is not just one meeting, but you have many meetings. When you come in the door, you shake hands with people and you have a short discussion. Then you sit down at the table and you talk to the person next to you. And then you have a presentation where you listen to the presentation. And then afterwards, you have, while everyone's wrapping up and going out the door, you have one or two more one-on-one meetings with different people. And you lose that as well in online. You don't have all these side meetings going on. You don't have all these introductions going on, because we're here for the main presentation in most cases. So some of the ideas we come up with to help with that is, number one, set up multiple meetings with different people and in different ways. And so instead of having one Zoom meeting for the meeting, have maybe a pre-meeting with one or two people individually to talk about what we're going to do in this meeting. And that could be one-on-one or one-on-twos type thing, the kind you do in the hallway at a company. And then number two, have your main meeting. And then number three, have a follow-up series of meetings, one-on-one, one-on-two with other people, to talk about what we saw, discussed, and so forth. And so I think we can get back to some of the elements of the physical meeting. Not sure if visible cues or body language is still coming through, but if you're having multiple meetings, you can start to get a better flavor for what you had in that physical room. In investor meetings, one of the key things is when investors talk with each other alone about the deal, that's when they really exchange ideas and learn from each other. And while you can do that on Zoom, it's not as effective as if you're in the same room. It's just a little bit less, maybe 20% less. And so having these other meetings will maybe help fill in some of the gaps until the technology improves, that we have more detail coming in. So the next question is, what is most important when building a virtual founder team from zero? How would you view a venture where the founders met online? So just as in in-person meetings, you're assessing skills and personality traits and communication skills, as well as their goals and interests. So you do so in an online or a virtual setting. Again, I think it's going to go back to many meetings and with different people. The thing I would do is have a meeting with a potential co-founder with one-on-one, and then bring other people in, other people that work in the company, advisors, investors, and have similar dialogue and questions. And you try and come at it from different angles as to what their goals are. And you're trying to figure out their personality traits and how they react to different people, how they communicate with different people. If it's just one-on-one, that's just one axis to look at. You really need to look at it from multiple axes. And if there's people that they're going to be working for, they should be in discussion. And at different times, if there are people that will be working for them, they should be in the discussions. Again, testing out how that's going and how that's working. So I would probably use multiple meetings to try and solve that problem. So the next question is, which books would you recommend entrepreneurs read? And so this is one I read a lot myself, and I've read some books recently I think every entrepreneur should read because I found them very helpful. The first is called The Great CEO Within, The Tactical Guide to Company Building. And if you, we'll put these in the show notes, but I found the advice to be very practical on hiring, on running meetings, on planning, defining roles, documenting processes, handling providers, and more. It was very eye-opening. I was doing many of the things already. It's great to see confirmation, and there are great new things I learned about that I had not thought about before. And I thought, well, that's even a better way. And so I recommend The Great CEO Within for those who want to start a startup because it'll help you with all the basic things you have to do in company building. The next book I would put out there is The 3-Minute Rule, Say Less to Get More from Any Pitch or Presentation. I read this because we do many pitches and we coach people on pitches. And I found it very interesting to read the book because this was a guy in LA who was pitching TV shows. And so all the examples around, The Biggest Loser and TV shows that he had put together. And he had a methodology for how you go through and figure out what you're going to say, how you figure out the value points about how it works and what it does and so forth. And I found what he was doing was really building the first 3 minutes of an entrepreneur's pitch. The problem, solution, the opportunity, that type of thing is what he was really drilling down to. And he was trying to get that done in 3 minutes. And found that in 3 minutes, that was about the amount of time an audience would give you for attention before they would be drawn away. And so he was crafting pitches that would fit into a 3-minute window that were quite effective, and later became a consultant and started helping startups raise funding by helping them on their pitches. And in the book, I found that at a standard 10-minute pitch that we do in the investors room, the first 3 minutes were very crucial for getting across exactly what you do, how you do it. And then the rest the next 7 minutes could be spent on the financials and the team slide and the IP and those type of things. The next book I would talk about is Start With Why, How Great Leaders Inspire Every Action to Take. And the idea here is run by Simon Sinek is know why you're building that company before you jump into the what and the how. And he makes the case, and I think does well on making it that, great companies have a very strong why. They know why they're there, and that will establish a connection with the customers that you will get beyond just tactical support or great teamwork or what have you. If you can establish a strong why, you're going to be head and shoulders above the competition because you have a cause greater than yourself. And so it's something that you should consider for your business as well. And the last book I would offer to startups is, What Customers Crave, How to Create Relevant and Memorable Experiences at Every Touch Point. And this is where you learn how to define the customer touch points and how to improve your customer's experience. Because as a startup, you're going up against entrenched competition, you're going up against bigger companies, more funded, better resourced, and you have to bring something that the others don't. And customer experience is something that startups can actually use to achieve traction and scale. If you have a better customer experience than anyone else, you can actually succeed against bigger competitors that did not put so much effort into that part of it. And it has a very good methodology for how you go out and you look at all the touch points you have with customers, find out what they like and don't like, and then improve the process. And I found it to be very readable and very simple to do. Didn't require lots of surveys and polls and all those things. It really required you to just go through it as a customer and talk to a few customers and figure out what they like and don't like and map out all the touch points. And I thought that was a very good book that most startups should read as well. So the next question is from Roger Moss. Thank you for joining us today, Roger. Thank you for the invitation to attend the webinar. My question is for you is that, will investors shift their focus from China to India now? And if yes, how can we get in touch with them? Roger, I think you'll see a stronger interest in India, not because it's not China, but because there's just some really great technology going on there. It maps very closely to the US markets and with the themes and the businesses that they're building. And I think you're going to see quite a bit of interest from corporate VCs into India, more so than standard VCs. Standard VCs will be interested, but I think corporate will be even more so. And India is tracking closely with the US and building out startups. And corporates would be interested for two reasons. One, they want to gain access to the India market, and two, it's good technology to bring back to the U.S. market and to the rest of the world. And so I think you'll see corporate VCs, leading the way into the market. In general, everyone's going to be taking a haircut and a downturn in the market because we're doing a reset because of COVID-19. And what happens in a reset is, and we saw that at the end of the dot-com bust, and we saw that in 2008, is that at the end of a long run-up, valuations are very high, probably too high, and there's been a change in the market, and we have to reset valuations back down, and we have to reset direction in which we're going to go for startups as far as investment theses and what customers will pay for and what the care abouts are. And then from there, we start the slow move back upwards and repeat the cycle again. And so in one sense, it's important to have resets because valuations were 30% overvalued and were not coming down. Well, now they're coming down. And if you get too far out of sight with valuations, this eventually becomes a problem, and that usually is when you go to sell the company. I had a VC once ask me, do angel investors ever have down rounds? And I asked him, what do you say that? He said, well, because I'm getting guys that have $5 million of revenue in their business and they want $65 million valuation. And I'm going, well, how do we get to that multiple for your non-recurring revenue business? And the answer is nobody ever had a down round. They just kept voting it higher and higher valuations. But eventually someone's going to pay for that business in an M&A or an IPO. And if the valuations are too far out of whack, they're not going to pay. And it's going to be a failed acquisition. And we see that a lot in the current IPO market with the WeWorks and the Ubers and the Lyfts. They had their prices well off from the top because I think they got ahead of themselves on valuation. And so that's what we have to think about here is if you can reset valuation back to reality and then carry forward, you're going to have a successful conclusion to the startup, not just a successful run-up. So in general, I think we're going to see the India VC market will be in a downturn just as the US for a period of time, and then it will track it back up, and we'll see more interest in India as well. Those are the questions that were posed to me today. If you have any other questions, feel free to type them in. I want to thank you guys for joining us today and appreciate the thoughts you have on these. These are great questions and I think very helpful to other people. Any other questions at this point? If you have them, go ahead and type them in. We're going to record this and post it online. Appreciate you sharing with anybody that you think would benefit from it. And we'll be back later this week for a coronavirus webinar talking about what's going to get funded in that economy. We've seen, like I said, we're taking a reset on valuations and people are redirecting where they're going to go. And we'll talk in our next coronavirus webinar about what those new directions are going to be. We started to see many trends pop up already based on what's getting funded right now and what will be getting funded based on current roles and responsibilities at the government level as well as on the corporate level. I think we'll see a renewed emphasis on secure supply chains. I think we'll see a renewed emphasis on manufacturing, and robotics and AI will see tremendous leaps forward. And we'll get into all of that in our next presentation and look forward to having you there as well. Were there any other questions? If so, raise your hand or tap the button and we'll be glad to answer those. Well, it looks like we answered everybody's question. As you saw in the slides there, if you would like to work with us on the presentation, let us know. Feel free to email me at hallmartin@10capital.group, and I'll be glad to answer those questions offline as well. I want to thank you for coming today and hope to see you back in the future as well.